These are some examples from chapter 5. We're working on job order costing. So we're using the book and it's exercise 5-10. Hardwood Company uses a job order costing system. Overhead costs are applied to jobs based on machining hours. At the beginning of the year, management estimated that the company would work 80,000 machine hours and incurred 192,000 in manufacturing overhead costs. Required: 1. Compute the company's predetermined overhead rate. 2. Assume that during the year the company actually worked only 75,000 machining hours, incurred 184,000 in overhead costs. Compute the amount of underapplied or overapplied overhead for the year. Explain why manufacturing overhead was underapplied or overapplied. All right, so the very first thing, part 1, that we are going to do is compute predetermined overhead rate. Predetermined. Remember, I can't spell very well. And overhead rate. Okay. So the way that we're going to do that is we are going to take manufacturing overhead costs. The calculation for this is estimated manufacturing overhead costs divided by total amount of allocation basis, or the machining hours. Estimated manufacturing overhead costs. And they estimated that it would be 192,000. Okay. And they estimated machine hours of 80,000 for the year. Dollars. Predetermined manufacturing overhead rate. MHO, manufacturing overhead. 192,000 divided by 80 hours. So our applied, step 2, part 2, is to figure out what happened, what did we actually apply. So we first take our predetermined overhead rate. Which is $2.40. We take our actual hours, which was 75,000, and applied overhead is predetermined rate times the 75,000 hours. Now we take the actual overhead incurred. So they told us we actually incurred 184,000, but we only applied 180,000. Label this applied overhead. So under over applied manufacturing overhead. So we take the applied and we subtract the actual, and so we have under applied overhead of $4,000. So when overhead is underapplied, that means that we actually did not add enough cost to cost of goods sold. So therefore, we would have to add more money. So this would be adjusted by increasing manufacturing overhead by 4,000, which increases cost of goods sold by 4,000 and decreases gross margin by 4,000. The reason that the overhead was under applied was because we made a guess of how many hours we were going to use, and we made a guess of what expenses were. We used less hours, so therefore we applied less overhead, right, than we initially estimated. But the actual cost of the total overhead was more than we estimated. That is why the overhead was under applied. So moving on to exercise 5-12. The following cost data relates to the manufacturing activities of Chang Company during the just completed year listed below. So the information is actual data. The company uses a predetermined overhead rate to apply overhead to cost to production. The rate was $25 per machine hour this year, and a total of 19,400 machine hours were recorded. Compute the amount of under or over applied overhead. Determine the cost of goods manufactured using the indirect method. Okay, so we have indirect materials, indirect labor, property tax for the factory, utilities for the factory, depreciation for the factory, insurance. These are all manufacturing overhead items. So the total manufacturing overhead cost for the year is $473,000. They also have direct materials and direct labor and work in process inventories. So the very first thing is we must figure out what the actual overhead rate is. So our predetermined overhead rate is $25. And actual hours was, given the problem, 19,400. So we're calculating the applied manufacturing overhead, which is $25 times the machine hours. And so our applied overhead actual was $485. Actual manufacturing overhead. And they gave that to us is 473. So under is negative, or over applied manufacturing overhead equals our applied minus. So we actually over applied manufacturing overhead by $12,000. So over applied manufacturing overhead, 12,000. All right. So now that we figured out that, we must complete the indirect cost of goods manufactured. So to calculate the cost of goods manufactured, first we're going to start with direct materials. And that is 375,000. That was already given. And then we have direct labor. And then we have manufacturing overhead. And we're going to take the manufacturing overhead applied. So this is going to give us our total cost of manufacturing total manufacturing cost equals the sum of all of these. So we add these together. Okay. We come up with 920,000. Now, we must add our beginning work in process inventory with, because this was already in process. That's the goods we are making, right? So the total of that equals the sum of these two items. And then we must deduct with inventory ending, because this is still work in progress. So we can't actually, we didn't finish manufacturing that. So they gave us a total up here of 70,000. And this is our cost of goods manufactured. Let's subtract this. And we get 890,000. So notice that I did use the manufacturing overhead applied rate and not the actual manufacturing overhead rate. This adjustment would be done to cost of goods sold at the end of the period. So this would be the actual cost of goods manufactured that we would calculate, and then at the end of the period we'd make an adjustment to cost of goods sold to reflect under or over applied overhead. All right. Now, moving on to exercise 5-18, or problem 5-18. So let me rename this problem 5-8. Okay. This is we are working on predetermined overhead rate, applying the overhead, underapplied and overapplied, and then creating an income statement. This is kind of an comprehensive problem about job order costing. So, Almeida Products uses a job order costing system. During the year, the following transactions were completed. Raw materials were used from the storeroom for production, 180,000, 80% direct, 20% indirect. Employee salaries and wages were accrued as follows: direct labor, 200,000, indirect labor, 82,000, selling and admin salaries, 90,000. Utility costs were incurred for the factory. Advertising costs were incurred, 100,000. Insurance costs were incurred, 20,000. 90% of it were related to the factory, 10% related to selling and admin. Depreciation of $180,000 was recorded. 85% of that is related to factory assets, 15% related to assets for selling and admin. Manufacturing overhead was applied to jobs at a rate of 175% of direct labor costs. Cost of goods goods that cost $700,000 to manufacture, according to their job cost sheets, were transferred to the finished goods warehouse. The sales for the year totaled $1 million. The total cost to manufacture these goods, according to their job cost sheet, was $720,000. Required: determine the under or over applied overhead for the year. Prepare an income statement. No calculations are required to determine cost of goods sold before any adjustment of under or over applied overhead. Okay, so part 1. Determine actual overhead costs. So, I'm going to go through each of these transactions and determine if it's part of overhead. Raw materials. Well, the direct raw materials are not, but indirect raw materials are. So raw materials, indirect. And it says that the raw materials were 180,000 and 20% were indirect. So 20% of that is going to overhead. Then we have indirect labor. So we have employee wages. Indirect labor is 82,000. All right. We have factory utilities. This is overhead. We can't assign this to one construction site or one manufacturing. So what are they? So we can't apply utilities directly to the job. So it's overhead. And that is 65,000. Advertising cost is not part of that. It's part of selling and admin. We do have factory insurance. So insurance was 20,000, and 90%, 0.9, was related to factory. So that's 18,000 for insurance. And then we have factory depreciation. It says that depreciation was 180,000, and that 85% of it was related to factory. So that's 153,000. The cost of goods, so we're just calculating actual overhead. So total manufacturing overhead. We're going to add all of these costs up. All right. So the actual manufacturing overhead was 354,000. So let's figure out the applied manufacturing overhead. And the way that we do this is direct labor hours. Let's see. It says that is direct labor cost. Direct labor cost. It's 175%. So direct labor cost. So we were told that the direct labor cost 200,000. And then so the manufacturing overhead percentage was 175%. So total manufacturing overhead applied equals the direct labor cost times the manufacturing overhead rate percentage per labor hour. So a total of 350,000 manufacturing overhead was applied. Our actual was 354. So actual manufacturing overhead incurred. So our under applied is negative and our over applied is positive. Applied manufacturing overhead equals applied minus actual. So we have under applied. Overhead under applied equals $4,000. So we would need to adjust cost of goods sold at the end of the period by $4,000 by adding to it because we have under applied. All right. Now part 2 of this problem. Let's go back up. Prepare an income statement for the year. Okay. So in order to prepare the income statement, we must adjust cost of goods sold. So unadjusted cost, step 1, adjust cost of goods sold. Unadjusted, so they gave us the unadjusted cost of goods sold in the problem. So they said cost of goods sold was 720,000. Add under applied manufacturing overhead, which is 4,000. Adjusted cost of goods sold equals the 720 plus the 4,000 that we under applied. We also must calculate total selling and admin costs. Step 2. Calculate total selling and admin costs. All right. So let's go ahead. So we have selling and admin salaries, I think was the first thing. We go up here, we had employee salaries, direct selling and admin, 90,000. All right. Let's see what else we had from these costs. Utilities were part of overhead. Advertising costs, that's selling and admin, 100,000. Advertising. All right. Let's see what else we have. Insurance costs. 20,000, 10% related to selling and admin. Insurance, selling equals 20,000 times 10%, $2,000. All right, let's see what else we have. Depreciation. 15. It was 180,000 and 15 was related to selling and admin. Selling and admin. It was, I believe, 180. So check that times 15%. Yeah, 180 times 15%. All right, so that's 27,000 in depreciation. Let me see if we have anything else. Manufacturing overhead, no. So these are our total selling and admin. All right. Okay. Now that we have selling and admin cost and the adjusted cost of goods sold, we can complete the income statement. So it's Almeida Products Inc. Income statement for year ending December 31st. Okay. These bold. I'm going to merge these over. All right. So we're going to have sales, and our sales were $1 million. That was given in the, I need one more zero. A little bit wider. That was given in the problem. Sales for the year were $1 million. Cost of goods sold. Now we're going to take our adjusted amount that we calculated here, and then we're going to come to gross margin equals. That is minus this. All right. And then we have less selling and admin expenses, which is 219, equals net operating income. So our net operating income for the year, after adjusting, is $57,000. And that is the comprehensive problem from chapter 5 on job order costing. This is an overview of chapter 5, System Designs, Job Order Costing. So managers need to assign cost to products to facilitate external reporting and internal reporting and decision making. This chapter illustrates absorption costing approach, and this is also known as job order costing. So absorption costing and job order costing. There are two types of product costing systems. First, process costing. A company produces many units of a single product. One unit of a product is indistinguishable from another unit of the product. They are identical in nature, which enables them to assign the same average cost per unit. Sorry. So some examples of this, when you think about something, when you sell the exact same thing, paper, if someone manufactures paper, you know, that would be something, it's indistinguishable, one piece of paper from the next piece of paper. And then you might have different product lines in there, but also Coca-Cola, if you're manufacturing Coca-Cola, one can of Coca-Cola is exactly like the next can of Coca-Cola. So that would be using process costing. Job order costing is many different products are produced each period. Products are manufactured to order. The unique nature of each order, tracing or allocating costs to each job and maintaining cost records for each job. So instead of just allocating costs in the process costing system, job order costing, each job is very different in nature, and we can track the jobs separately in order to give exact cost for that specific job. The types of products that you would see job order costing would be aircraft carriers, tankers for military, Boeing manufactures airplanes, Construction projects, currently we're putting up a new building at Elms, so that construction project, everything that architect will do and those construction people will do will be allocated to that specific job because they'll be traced the product to go into that job. A movie production, each movie is different, and they would job order cost the actual movie to figure out the real cost of the movie. So comparing process and job order costing, for job order, you have many number of jobs. You accumulate costs by job. So you would have job number 1, job number 2, job number 4,000, and each job would have their own costs associated to it. And the average cost is computed by job. Whereas if you're manufacturing like Coca-Cola, although they have manufacture different products, Coke, Diet Coke, which have different ingredients, they would have a single product, they would accumulate cost by department, and then they would calculate average cost per department. So we're working on job order costing in this section. So job order costing, an overview would be you charge direct materials and direct labor to each job as the work is performed. So, for example, construction companies have multiple projects going on at once. So the construction company, and I don't know the name of the people working at Elms, they would have certain employees on job 1, they would have other employees on job 2, and they would have other employees on job 3. And so you would directly assign each employee and their time to the job order that they were working on that day, that week, or that month. Direct labor, direct materials. So specifically, we're building a science building. So all the materials that the construction company brings on site would be traced directly to the Elms College job. Now, manufacturing overhead is different. It can't be directly traced. It includes indirect materials, indirect labor, and are allocated to all jobs. So the company calculates a manufacturing overhead rate, and they allocate it to jobs. So, why use an allocation basis? Manufacturing overhead is applied to jobs that are in process. The allocation basis, such as direct labor hours, so there might be a manufacturing overhead cost per labor hour, or direct labor dollars, so per dollar that we spend on labor, there's a manufacturing overhead cost, or machine hours. It's used to assign manufacturing overhead to individual jobs. The reason that we do this is because it's very difficult to trace overhead to a particular job. The grease that goes into maintaining the tools for the construction site can't specifically be traced to Elms. Manufacturing overhead consists of many different items, and then many types of manufacturing overhead costs are fixed, even though output fluctuates. So fixed manufacturing overhead, we have, predetermined information there. So the application of manufacturing overhead. So when we're doing this job order costing, we come up with a predetermined overhead rate. This is used to apply overhead to jobs before the period begins. A lot of times, construction companies are outside, they're bidding for that construction project. So therefore, they have to apply a predetermined overhead rate. That might not actually be their overhead rate, but they're going to have to estimate. So it's estimated total manufacturing overhead cost for the coming period divided by estimated total units for allocation during the coming period. Ideally, the allocation basis is a cost driver that causes overhead, like labor hours, machine hours. So in that construction industry, it would be labor hours or labor dollars, but probably labor hours. So the application of manufacturing overhead. So predetermined overhead rates are calculated using a 3-step process. First, you estimate the level of production. Second, you estimate the total amount of allocation base in the determiner that would be required for that level of production. So we're estimating, all right, how many products are we going to produce, or how many things are we going to build this month or this year? Then we divide it by our estimated costs. And that gets us an estimated manufacturing overhead cost. And that's what we use to allocate when we're pricing out jobs. This is a very important step. So, applied overhead rate. So, first we estimate a predetermined rate. So, let's say it's $8 an hour. So, we come up with $8 per labor hour is our manufacturing overhead. So when we make an estimate for the cost of this project to figure out if we should bid out the project or not, we apply we come up with a predetermined rate. Then when we go ahead and actually apply the overhead for that job as it's happening, we take the predetermined rate, our POHR, predetermined overhead rate, times actual activity. Originally, we just estimated activity, but obviously if we're completing the job, we know what actual activity is. So here's an idea of what happens with the documents when we're in a job order costing. So materials requisition. This is a request for materials. And the direct materials go directly on the job cost sheets. So if I bought, 12 steel beams for Elms College building, that is a direct material to the job sheets. Now, if I bought, a box of screws and some tape, that would go to the manufacturing overhead account, because the box of screws may not be all used there, and we may not track each screw. The tape may not all be used at Elms, so that's going to be in the overhead rate. How the employee's time may be direct or indirect. Now remember, we talked about managers' salaries and then the actual people working on the floor, making the product. So if I'm working directly on the Boeing aircraft, that is direct labor. But if I'm a salaried employee taking care of a bunch of employees that work on different projects, I would be indirect labor and therefore be part of the manufacturing overhead account. So inside manufacturing overhead, we have other actual overhead charges, depreciation, utilities for the factory, other things that go in there. Then we have indirect labor and indirect materials. All of these add up to calculate manufacturing overhead. Then you actually apply the overhead to the job cost. Now remember, we applied a predetermined one, so we may be over, we may be correct, or we may be under. So the difference between overhead cost applied in work in process and the actual overhead of the period is referred to as either under-applied overhead or over-applied. When we have under-applied it, that means we guessed but actual costs were more than we guessed. So this exists, and we would have to adjust our overhead. We would have to make the change to add more cost to it. Now, if we over-applied overhead, this means that we guessed cost, but it was actually more than our real cost. So therefore, we've over-applied the overhead. And we would have to reduce the cost that we applied to the project based on the fact that we really applied too much overhead to that project. So over-applied overhead, you would deduct from cost of goods sold when you make the adjustment, and under-applied overhead, you would add to cost of goods sold. When you're calculating your predetermined overhead rate, you're using an estimate or a budget amount of allocation based on, the basis has been criticized because basing predetermined overhead rate upon budgeted activity levels in product costs that fluctuate depending on activity level. Also, calculating predetermined rates based upon budgeted activity charges for costs that they do not use. So sometimes what happens is people aren't very good at estimating costs. And this happens with all kinds of different types of industries, but they may not take into account capacity. They may not take into account actual expenses that they use. So there are problems with predetermined overhead rate, but it is a process that people use. So we're actually going to go ahead and move forward in chapter 5, and I'm going to post another video with examples of actually applying this predetermined overhead rate and then deciding whether it's over-applied or under-applied, and then making income statements from that. So that'll be the next video.